All right, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, October 19th, 2023. It is 12:51 p.m. Eastern Time. I'm starting the video, and we're going to start out here with an overview of the equity markets, key levels to watch, where I think things are going, and again, the key levels to watch and developments to watch for will either help to solidify the case that I still think there's in the coming months. Plus, we're going a lot lower in the stock market, but by no means can I still, or at least at this point, can I rule out the alternative new high scenario, even though it's not, and nor has it been my preferred scenario, really at any point. All right, this is just QQQ. I'm going to just start out here for what I like to do every now and then is, always take a look at the longer term chart. So I got out to yesterday the comparisons using the NASDAQ composite. Remember, the QQQ is the NASDAQ 100 index, which is the 100 largest companies in the NASDAQ. So, and again, it the ones that it intentionally excludes financial stocks. It's mostly tech stocks. And so I gave you the parallels. What I did, and I mentioned it too, I want to be full disclosure. I turned it from log scaling to arithmetic scaling, aka linear scaling, and that just paints a little bit different picture, but it does show, we had a similar market where we had a normal, strong bull market, and then the thing just hit the turbo boost in the late 90s with the dot-com bubble and all things tech. That's when the internet and people were just starting to realize how the internet's going to change the world. And it certainly did, but obviously we got way overhyped. And so you had that parabolic advance into the top followed by an initial leg down. I gave you the stats yesterday, and I put in, that parentheses, because I had, more than one subscriber, and I've heard it on TV talking about how the rally off the October lows from last year in the market couldn't possibly be a bear market rally. It's just too strong. So then I kind of gave it to you there. You can measure it out yourself. QQQ. I used the NASDAQ composite yesterday, but the QQQ, that was a 44% rally, and all it was is a simple run-of-the-mill bear market rally. And what I've explained in the past to support the case that this that move is, in my opinion, probably just a bear market rally and still easily can be, is because people, I know it. I don't think I know it. I can see them, talking on TV and, the so-called experts. They don't put things in perspective. The market is supersized. It was McDonald's that came out with the supersized meals recent, a while back. It's been a while, but jumbo size your fries, get a friggin' quart or of soda if you want to supersize your meal. Well, the Fed supersized the stock market, and they were juicing it back then too as well, keeping rates artificially low. And of course, we all know they did that, since the financial crisis, and kept the pedal on the metal way too long after bailing out the financial system in 2008. But, so again, when you look at a chart, and that's where Fibonacci retracements come in too, is they put things in perspective for percentage moves. And so that gives you kind of relative to the previous move, it tells you right here to that drop, that was a run-of-the-mill 61.8 fib retracement. And you look at the S&P 500, and now I have to zoom all the way back there again, but okay, here it is. Anyway, you can put up the fibs. I would use the comparison of the NASDAQ because that's where the the bubble really manifested back then. And this time around, if we go back to QQQ, let's turn that off. Tech is once again, been the driver of this, very largely the driver of the rally that we've had in recent years. And here it is. And this time around, you would probably say if anything was a bubble in the NASDAQ, forget about Bitcoin, that's its own separate asset class, its own bubble. You would say it's the AI bubble. And I think very few would disagree with that it was AI, talks of AI and how it's going to change the world and change these companies, and NVIDIA being the poster child from that rally off the October lows. And here it is for you measured out just for comparison purpose, 51%. A little hotter than that previous one, also a little hotter on the fibs. But again, until unless we take out those previous highs, that made a mess of things here. Let me take that away. Go to a board I might have over here. No, all right, I've got lines all over the place. So guys, I was going to draw it. We're, I think, at the 78.6 fib on this rally. All right, let me step it down we'll look at it right here. This is a weekly chart. It's quite busy. Is this the board I wanted to show you? No. Oh, okay. Yeah, remember I just changed it to arithmetic. All right, so there's logs, scaling. Again, what I call a busy board because I have a lot of lines here. But you can see for the most part, this was the end of the last bear market. You can call whatever you want a bear market. It's semantics, really. To me, that old antiquated measure of a 20% drop is so, again, antiquated for lack of a better word, because of the magnitude of the moves in the market in recent decades with all the excessive easy money policies. So, you can just eyeball it, and the last couple true bear markets were both about 55% drops there. That was that was the 85% in the dot-com bubble, and then the previous one, the financial crisis. Both the S&P and the Nasdaq fell about 55%, and then everything else, in my opinion, including COVID, was a correction. You want to call a bear market a 6-week drop? Call it that. It was over 20% in the Nasdaq. It was about 35 in the S&P, but it's what I since at the time I dubbed it Ursa interruptus, kind of my rough Latin made up word for a bear market interrupted. The Fed just didn't allow it. The federal government didn't. It wasn't just the Fed. Obviously, it was DC too, throwing helicopter money out the window to everybody. So that's it. Oh, and where we're going is I believe, if I'm right, this is first leg down, just like that first leg back in 2000. I'm using that comparison there. Big juiced up counter trend rally based on, again, the magnitude of the bull market leading up to it, one of the longest and strongest in history. So therefore, you're going to have bigger waves. And for every other reason, fundamentally, which I've talked about before and since this bear market started, again, I'm going off the fact that it started back here in November of 2021 for the NASDAQ. Mainly the fact that we ended, in my opinion, and both my opinion as well as, it's hard to argue from a technical perspective, we just ended a roughly 40-year secular bear market in interest rates, which is now, by many metrics, show that's over. Again, we'll see what happens, but it looks like we've embarked on a new bull market of rising rates, and that's going to provide fundamental headwinds, not for months or weeks, but for years and even maybe decades, prove to be a headwind for the market. It doesn't mean the market has to drop for decades. It just means I can't tell you what to do. Used to be the role, wear the hat of a financial advisor, but let me just say this. In doing your retirement planning, if you want to take and play the game the mutual funds and some of the retirement planners will take, if you take the returns, especially of something like the NASDAQ or even the S&P, and you're only looking at the last couple of decades, I think you're doing yourself a disservice. I think it's probably better to temper down and realize that those were outsized, above average gains in the stock market. And again, why? Because if you just go to, you look at the Treasury bond yields, you can look at the 30 or the 10-year, something, again, I've covered many, many times in the past. This is the bear market in interest rates. This is when rates peaked. I think Carter going out of office, Reagan coming in, hyperinflation in the 70s, the last time we've had a similar inflationary environment. And then Volcker won the battle and, ended, but we peaked at near 20% on a lot of on interest rates on shorter, 10-year and all that. We're up there in high double digits. And then you can see a clear downtrend, a clear channel. That's the downtrend. And that ended with a big selling climax, if you will, as a lack of a better word, because these are rates. That was when the Fed hit the nuclear button, when COVID hit, and took rates down to the floor. And then again, by every metrics being, taking out previous highs and the primary downtrend line, that tells me this was the end of that secular bear market in rates. This is the first leg up. Now, I don't think it's going to go up like this. That would just we'd be throwing stones at each other and and living in caves if that happened. The world would come to an end, the financial system, and there'd be mass. So it's not going to happen that way. But we can come all the way back down here. We will eventually, I believe, trend up over time. And whether we do or don't, I've also used the analogy kind of like, if you're a trauma doc in the ER or a hunter, I give you both the same analogy, then you know this to be true. You get a kill shot, you hit your deer in the heart, he's going to drop. You hit the lower lobe, in the lung or something, the deer is going to run, he's going to bleed out and die later. Same thing when people are rolled into the ER. If they're killed right away, they go to the morgue. If not, they come into the ER. Sometimes they make it, but quite often there's irreparable damage if internal bleeding, a major artery severed. And that's what I think has happened to the financial system. It just doesn't, it had so much juice, it was hyped up on so much adrenaline, meaning easy money, that it's defied just about every economist out there how this market is in the job market and everything's holding up. But it's the lag effect. And again, we're coming off an unprecedented period of excessive intervention in the financial markets and excessive easy money policies and quantitative easing. And so the billion-dollar question is, how long is the lag effect going to be? Not, is there going to be a lag effect? Again, don't fool yourself. There will be, and we've seen it. And I've highlighted this. We've seen things break. We saw the banks break earlier in the year, some of the biggest bank failures in U.S. history. And I pointed out repeatedly all my things to watch list, one after another check marks I'm getting. So let me get off that fundamental rant and get back to the charts. While we're on this, I gave you trade idea that I'm still watching right here. TLT, if you trade ETFs, that's the 10. I'm sorry, it's the 30-year. They track the 20 to 30 year. They're trying to track the 30-year bond, but when you do that, you can't only hold 30-year bonds. That means every single day you have to buy the new, or every week when the new auction comes out, 30, and then sell everything that has 29, years or 29 years and 6 months left on maturity. That's why they call it the 20 plus year. But they're targeting, this is supposed to track the 30-year bond. They're just, to keep fees low, they're not going to sell every bond every time one that they've held and it's now a year old after the 30-year after its initial issuance. So hope you understand that, and that's so you have just a pool of long-term treasury bonds, and when they get down towards there, they'll sell those and roll them and buy new longer-term bonds. And so as I said this morning, like any trade, I don't think I'll ever put a trade out that I can't make a decent case to buy technically. But I'm also putting this out here as both a pure play, just based on the charts. It is clearly, and make no mistake about it, clearly in a downtrend. This is 110% a counter trend trade, which makes it aggressive. It is a catch a falling knife because it's just at 52-week lows. Interest rates are continue to break out to multi-year highs. We haven't seen rates this high since the financial crisis in '08, or leading right up to that. And so by that metric, it's an aggressive trade. Any counter trend trade is aggressive when you're trading against a trend. However, this tells me I see divergences building. And then, so other than just a counter trend trade to try to catch that as a pure play, as I mentioned in the post this morning, I believe it could be used as an indirect hedge, because if this does happen, one of two things most likely will cause interest rates to do this. One could be an abatement in financial risk. We see, in other words, just natural forces start to bring yields down a little bit, and the 20 and 30-year bonds rally, and interest rates drop, so bond prices go up. And as long as there's not a shock to the markets, equity markets aren't under duress, this isn't happening for a flight to safety bid, that would be net bullish for the stock market. The stock market is hypersensitive to interest rates right now. And so any decent and notable abatement in yields, which would be a rally in bond prices, would be net bullish for equities. All right, so that's that. We just need to get an impulsive breakout here and then which we don't have yet, and that should send the 30-year up. Then on back to the equity market. So QQQ, let's just start out here. I was on the weekly, start out with, here's a daily chart. Again, key levels are the blue downtrend line. You have this uptrend line right here. I'm going to draw it on the 60. Let's drop down to the 60. These are colored up here. You have the primary downtrend line off the highs right there. Probably the single most significant technical level right now on this chart. Whereas a breakout above that would be bullish and would most likely send us higher. Anything other than a failed breakout and then pop and then drop. Then I also have an uptrend line here off the lows. You have 3 reactions there so far. So that gives us a symmetrical triangle pattern. These are indecision patterns, and you need to respect them because typically from those, whichever way you break, again, other than a brief whipsaw, that usually determines the next tradable trend. So you can, again, you can replicate that on the daily as well. Here, I'll do it right now. And we'll even color it up. I've got all these color codings going on. I don't have the purple lines here. Those are on the, remember, the market leading things. And then going back to that 60, you have a minor downtrend line right here that may or may not come into play. I'm not super crazy about it. There's a few reactions. You can play around. You could probably draw a trend line here. Yeah, I think this would come into play too if that other one's taken out. So these are your resistance levels. And then most importantly, our horizontal support and resistance levels, or at least one of the most important right here. So recently I talked about roughly this. I talked about this area here. There's a big old gap, very large, prominent, technically significant gap. The top of that gap was really the top of this trading range for the NASDAQ 100. But remember the NASDAQ 100 futures NQ, but those trade around the clock. And so a lot of the reaction highs that the NASDAQ 100 futures had up here did not show on QQQ because we're looking at a chart here that goes from 9:30 to 4 p.m., regular trading session. So with that being said, this, as I mentioned the other day, is the top of this trading range right here. And that number is 361.65, and we just hit that. I would have been surprised, not shocked, but surprised not to see the buyers buy it. And they almost, they got close here. So this is now the third test and successful test of that level. Obviously, that level is going to need to go with conviction for my preferred and primary scenario to play out. And that is, we go down here, and then we take out the trend line, and then we take out the lows. At that point, it should be lights out. We take out these previous lows there, and we could get the party started. If this trend line goes. This trend line again only has 3 distinct reactions right now, so it's not a super solid one, but it's worth noting. So there's your levels right there. What else can I point out? There's something for everybody here. The market continues to, it's been conducive to active trading for sure. You get these rips, dips. I talked about it yesterday. Somebody said, "Wow, that the bullish, the buying, the rips to the upside feel bullish." Well, they always do. When volatility is high, you get these above average and quick, moves up. And again, as an active trader, if it's your thing, they're very profitable if you can trade them successfully. And if you don't know what you're doing, that's not your skill set, this market will chew you up and spit you out. So the best thing to do is either position, as a swing trend trader where you think things are going, and then sit tight with your trading plan in place, your stops if wrong. I'm just tightening up that trend line. Or stand back. There's nothing wrong with waiting for a definitive breakout. And again, above or below the triangle should do the trick. So those are your levels to watch. Again, another full tag of that level right there. So we hit support 361.63, and we also have some divergences on the shorter term charts. 5-minute chart. Remember, this is the realm of the active trader, day trading, active swing trading, which means, day trade by definition, you're in that day and out, closed out by the end of the day. But being that the futures trade around the clock, I usually consider it, I call it active swing trading, where, if you buy something and let's say it's the futures and you think it's going to go from here to here even, maybe you hit that intraday, maybe in the same trading session it does that. But if you're only halfway there, market closes, you go to bed at night, you just leave your sell limit order in place with an OCO order. One cancels the other. That'll sell you out if it's hit there, and your stop's going to be wherever you put it. And so whichever the first order is hit, the other one gets canceled. So there's really there's no delineation anymore, at least for futures traders, except weekends. The futures do shut down for good on Friday and then open back up on Sunday evening. Okay, so where are we going near to? Well, again, I showed you we hit key support on the 60-minute chart, which we were just at on QQQ, and we did it with positive divergence here on the 5-minute chart. Here's that other, I think this is a downtrend, one of the downtrend lines I gave you on the, I gave you, I believe, these two I just drew on the 60. So we popped this one. I think all this noise here today, Powell was flapping his jaw at noon, I believe. I didn't watch it, but I saw on the economic calendar he was set to speak. So if you're actively trading, day trading, and you think you're losing your mind, well, that's what's going on. The algos the computers are taking over today. And here, you probably don't know what I'm talking about. There's a 1-minute chart. This is it. There he is. Powell was supposed to come on and talk at noon, so it's like trading a Fed day. The market doesn't know. This market is schizophrenic. It doesn't know up from down, if it wants to go up or down. But again, I talked about that yesterday too. Take a step back, turn off all the lines. What is this, an uptrend or downtrend? Well, it's an uptrend off the, since the beginning of the year, but it's a near-term downtrend. And if you're a trader, an active trader or a swing trader, this doesn't matter to you. Long-term investor, you might say, okay, the primary trend, well, no, guess what? The primary trend, actually, when you go back here to a daily chart and turn off all the lines, well, here's where we peaked back here. So, again, I do this. That's why I started long-term. If you agree that the market's going a lot lower, then I can tell you this is pushing the upper limits of a bear market rally. So in my opinion, it's a great time to re-enter, to get short, or be short. As a swing or trend trader with stops, I gave the levels. I told you if they pop that downtrend line, that's probably going to bring in a lot of buyers. That's an objective level to place a stop. I told you that the other day when we hit it a couple weeks ago right here on the last run up. I said beautiful short entry there with a stop somewhat above. And now at this point, well, you can leave stops there if you're shooting for the whole enchilada, or you can lower stops to where you want any of these resistance levels I told you to protect gains if you're if that's what you're doing. Let's look at SPY real quick. Let's do that. SPY, what did I jump to? A 60-minute chart here, divergent high there, negative divergence, no divergent low on the 60. These tend to be what I like to see when I am in typical swing or trend trading mode. I like to go long and or cover shorts when I get positive divergence on the 60-minute charts of the main indexes, SPY and QQQ. That's what we had here. And then especially when the primary trend is bearish, you want to get short again at these divergent highs. So that's what we had on SPY there, and then QQQ as well. So this was the last swing or trend short entry, and we do not have, at least not on the SPY and QQQ, we do not have positive divergence. So I can, again, reiterate that I think, for swing trader short, I think the case is made to stay short unless the charts convince you otherwise, such as breakouts above the downtrend line or anything else. So that's it, guys. There's the battlegrounds. We need to take out 361 with conviction, and then this trend line to open the door to more selling, increase the odds that we're going a lot lower. And bulls need to break out these, above these downtrend lines, and most importantly, above this level there. All right. I've gone over the FANGs so much lately, the Magnificent Seven, including yesterday. There's no update. The only one I would update is Tesla, because they reported. And so what you have, this is my daily chart, same one I would have covered in the last update. We took out, there's a sell signal and a breakdown of the uptrend line off that April low right there. So remember, we had this smaller triangle pattern here, your primary bear market downtrend line, and we actually broke it yesterday. There's our breakdown candle, and just follow through downside today. So like a lot of the big tech stocks, tech related, you've got the 200-day moving averages, and you're coming up on my 212.80 target right here. But we're in no man's land, so I would think yeah, it depends what the market does. If the Qs can rally from here and build on those 5-minute positive divergences, then yeah, Tesla will probably run up, maybe make a back test of that 241.28 level. Otherwise, if the Qs roll over, if we close red today and or tomorrow, especially a solid red close, it's probably going to bring Tesla down to at least that 212.80 before the buyers step in. So it's in no man's land. I wouldn't touch it right now. That's just me. I should wrap it up here. There's too many things to cover. If I start going into gold, silver, everything else, I can just tell you that there's some, here, let me show you real quick. Some pretty steep divergences, negative divergences, that is, building on gold. It's kind of a mixed bag, because from a bullish perspective, we took out this downtrend line recently, and that's a breakout right there. We're diverging right now, and so basically there it is. There's your trend line. Break of that trend line is going to bring us down. Probably come back for a back test. There would be your target, 1940. From a longer term perspective, and again, there's things going on in this market. I told you when this thing happened, it seemed to me like a fund somewhere was blowing up. That drop in gold was not. It did break support. Broke a key support level. Silver especially. Silver did the same thing, but it wasn't commensurate with the move in the dollar or the euro, which usually coincides with big moves in gold and silver. And then, it was either engineered, because look at the ensuing rip, or again, maybe a big fund was blowing up and had to unwind a position because they were over leveraged and needed to sell what they had, and they had a lot of gold. I don't know. But the fact that we recovered it, remember, this was a pretty key support level. And we went long here and put it out as a long. We were long before, but then stopped out right here and then added it as another long, both gold and silver. But here's this is fairly unusual price action, that V like that. I can tell you it went from oversold to overbought in the blink of an eye. That's unusual too. Look how deeply oversold it was down here on the RSI. But I just gave you the trend line on the 60. So, break that trend line, we're probably going to get a pullback. If not, there's a little more resistance up here, about 185 or so on gold. Silver is the same thing. Silver had a beautiful support level. As mentioned, stop right below there. I mentioned going long on these last couple, but then re-entered it right here when along with gold, and rode up. We hit, what is that? I gave you 3 targets. We already exceeded that. That was what time frame did I give you those targets? Daily? Nah, either way, this is silver now. So like gold, it took out a near-term downtrend line recently, but like gold, it also has some pretty big negative divergences building, just like we had positive divergences here at the lows, gave us this leg up. And silver, you can see, just rolled off that resistance level there. So at minimum, probably going to come back here for a back test of these levels. And if we break them again, well, especially if we fail back below that trend line, that's going to be bearish. But again, there's been a lot of volatility, a little bit unusual, how quick that reversal. But it's not much different from this one here. You had that spike up, put in a divergent high. And again, these divergences are kind of the best guide if you want to succeed in this market or survive in it, trading things like this. Just, look out, sniff out those divergent highs and divergent lows. And you don't have to short them. I always say divergences are not necessarily a buy. They're not buy or sell signals, but they are an indication that a trend reversal is likely coming. And so therefore, and nothing else, you don't want to start buying when you're, overbought with divergences, and you don't want to be selling or shorting when you have positive and bullish divergences, especially when you follow support. So there's your updates on gold and silver. Again, when Powell speaks, it's, the market listens, and it's all about the euro. So this is what happened, the euro US dollar. He spoke and euro shot up here, and that's what's caused gold and silver to shoot up today in the market. But think it's going to get sold into. I think gold and silver, like I said, good time to sell them, in my opinion, if you have them, or just tighten stops, let it run. Sometimes I'll continue to run, but I'm favoring a pullback here in the equity markets, gold and silver. And there's a near-term uptrend line right there I just drew for you as well. And I put this because gold and silver are positively correlated to the euro-US dollar pair. So that's it. Still favor more downside in the equity markets, considerable more downside, waiting for some additional sell signals in particularly the market leading big tech stocks, Apple, Microsoft, Amazon, etc. All my, that's not the right board, all the purple lines there and those guys. And, you know, we're starting to get, as I said, in recent days, more and more evidence building, more of the red flags, or yellow flags waving. And yeah, and that's it. Let's wrap it up here so it's not a super long video. And then anything else I missed, or if you have any updates on anything, there's been a gazillion and one individual stock trade ideas and sector trade ideas in recent months. If you want updates, just drop a line in the comment section. I'll be glad to do that. This has been Randy Finney with Right Side of the Chart. Have a great day.